And thank you for joining us today. It's 11:30, so we might have a couple stragglers come in, but we'll go ahead and get started just so we can stay on time. Today, our topic that we're presenting on is red flags and deal accelerators and financial due diligence. I'm Aimee Werner, and I'm an M&A director here at Lutz, and we also have Morgan Felber presenting with us, who is also in our M&A department. As for agenda today, we're going to go over identifying common red flags in financial due diligence, understanding quality of earnings and why it matters, avoiding costly mistakes that can derail transactions, and recognizing deal accelerators that build buyer and seller confidence. So recognize that everyone online today is probably in a different circumstance, whether you're a potential buyer, potential seller, or advisor, but hopefully today, some of the key points that we talk about today are relevant to everybody. Okay, so if any of you are not current clients of Lutz, a little bit about us. We were founded in 1980. We're a business solutions firm headquartered out of Omaha, Nebraska. We also have locations in Grand Island and Lincoln. We're at about 307 employees and counting, and really what we pride ourselves on when we say business solutions firm is our ability to offer the Lutz network to our clients. So here's just a quick overview of some of our service offerings. We've got your accounting, that includes, audit assurance work, tax work, and client advisory services. We've got our wealth management team and Lutz Financial, as well as retirement planning services. Our M&A team, which is where Morgan and I sit, talent team that does search and staffing for our clients, as well as outsourced HR and HR consulting. And then our tech team, which is outsourced IT, MSP services, as well as data analytics and digital transformation. So I know the buzzword that everyone's talking about is AI. So if you think of artificial intelligence, automation within your business, they are a good contact. Okay, so Lutz M&A, we kind of think of ourselves as three pegs to our stool. So we've got our business valuation team, we've got our transaction advisory team that focuses on sell side and buy side transactions, and then we have our full sell side team, which is the full sell side auction process where you go through a competitive marketing process. But really, I think the key takeaway for Lutz M&A is if you are thinking of buying, selling, transitioning a business, come talk to us. More than likely, there's a way that we can help. All right. Okay, so with that, I'll hand it over to Morgan.
Kicking off the first section here, identifying common red flags. So in this section, we will cover how to spot red flags or warning signs early, prior to a transaction, hopefully before they become some sort of deal slower or deal breaker. So focusing on why financial due diligence matters, we'll kind of go over more of the financial side of things. However, it's really good to consider all of this commentary across a lot of different sides of the business, including legal and such. So red flags slow deals, specifically financial inconsistencies can raise flags to buyers. So if you have unclear or inconsistent financial information, this can often result in either additional due diligence, pricing pressure, or deal delays, and this can even result in a retrade or repricing of a deal. And then surprises that are discovered late can slow deal momentum and can result in a slower close, which isn't good for anyone. It can result in deal fatigue for both buyers and sellers. And we'll cover deal accelerators today, which create more confidence, which is really good for a buyer and a seller. So if a seller has transparent, well-supported financials, they don't have to be perfect, but a seller's ability to kind of understand and talk through how their current practices are done is key. A buyer can move faster when risks and adjustments are clearly understood. That's kind of where this consistency piece comes in. As long as the seller is very consistent on their financials and accounting, it's more helpful for advisors and buyers to kind of jump in and understand what's happening there. And then the best transactions are built on preparation, transparency, and a disciplined process. So what is a financial red flag? This is an indicator that something may be incorrect, overstated, or hidden within the financials. So red flags aren't automatic deal killers, but they typically require more investigation to kind of determine what is the next step to remedying the issue. Most deals we've encountered here, there is some sort of red flag that emerges at some point, but the response and the remedy is typically the driver of the deal closing or not. We'll hit on three main buckets today. So financial statement risks, operational inconsistencies, and then management and governance issues. So that first bucket, we'll start with financial statement risks. So this is the most common set of red flags. This isn't an all-inclusive list, but these are kind of the most common ones we see. And I'm going to kind of jump around here a little bit, but I'd say the most common one we typically see are revenue recognition and cost recognition issues. So this is kind of that discussion on cash versus accrual financials. So this is where we see the incorrect timing of revenue and expense recognition, and this can kind of result in large adjustments to EBITDA. So we've seen this quite a bit across the businesses that we've assisted with. And we've noted that it's a lot easier to kind of create and calculate this cash to accrual adjustment for businesses that are very consistent in their current practices, even if they aren't on an accrual basis. Being on a cash basis isn't a bad thing, but just kind of getting those adjustments, it's easier if the business is more consistent throughout. And kind of on that same thing here, we talk through unusual year-end spikes. So this can raise flags related to early recognition or improper recognition of revenue. And then another big one's inconsistent gross margins. So typically we should see your margins being fairly consistent. So any unexplained margin swings can indicate cost misclassifications or, as I kind of mentioned earlier, improper cost recognition. Another big red flag we can see is revenue concentration. So this is typically a customer concentration where one or two customers represent a large majority of the company's revenue. So this is where a loss of the key client could be a big risk. And, we've noted, is there customer contracts that could be in place? This is typically a big piece for a buyer. If there's a contract, they have more comfort on a customer concentration risk. Non-recurring revenue as core revenue. This can be one-time gains, insurance proceeds, or asset sales that look like it's income on the financial statements, but typically we have to pull that out when calculating EBITDA. And kind of the last one that we look at is declining backlog versus revenue growth. So this is when, your revenue's increasing, but you have a declining backlog, which can indicate that maybe your company or a company is at the peak of its earnings. This typically raises somewhat of a red flag to buyers just when they're determining the company's value, because typically they don't want to determine value on the peak if the company's kind of on a decline on the back end. So that's something that we like to call out as well.
Yeah, and I think just to add to that, a lot of times we'll have clients come to us with their best year ever from a performance perspective and think it's the right time to sell, which it may or may not be, but being able to answer the why was it your best year ever? Did you have, a large project or customer order? Maybe there were unique circumstances, or is it truly something that's sustainable going forward, because a potential buyer isn't going to come and pay you on your best year ever if they don't think they can replicate that year over year. So again, I think as Morgan said, red flags aren't necessarily deal killers, but not being able to explain those red flags that arise, that's ultimately what ends up killing the deal or retrading, having to reduce the value.
All right. Kind of moving into focus on working capital and cash flow red flags. So a big thing we see is that a company can report a strong EBITDA number, but they have weak cash flows, which can raise concerns from buyers. And kind of the two big places we recommend looking to kind of determine where this is driven from is starting with accounts receivable. So you can pull an accounts receivable aging report and see if there's any collectability issues, or slow payers can drive cash flow constraints. Any balances over 90 days typically indicate a slow payer, so we look for that. And another big piece is inventory. So if inventory is growing faster than revenue, this can typically indicate that maybe there's a weaker demand in the market for the company's products or services, or there's obsolete inventory that maybe hasn't been considered or written off on the balance sheet. That's a big piece as well. And then days sales outstanding, if that's increasing quarter over quarter, this is similar to inventory buildup. This can indicate a slowing of demand or softening in the market. And then negative free cash flow. So it's always good to review your free cash flow figures because this can indicate weak or negative earnings, which is a concern because typically healthy businesses should be converting their earnings to cash. So we included on the left here some key metrics to watch from a working capital perspective. So the days sales outstanding, days inventory outstanding, days payable outstanding, and then the cash conversion cycle.
Yeah, and I think a common misstep that we see both buyers and sellers take when looking at transactions is just purely focusing on the income statement. And yes, we'll talk about EBITDA or free cash flow throughout this presentation. And oftentimes EBITDA is the metric utilized to determine value. So it'll be your adjusted EBITDA times a multiple. However, if you just completely ignore the balance sheet, to Morgan's point, okay, your income statement may show that you're making money, but then all of a sudden you flip to the balance sheet and you don't have any cash. Maybe you're fully extended on your line of credit. Well, where did the cash go? And what Morgan's talking about is, okay, are you not collecting from your customers? Are you buying too much inventory and it's not being converted into revenue? Things like that draw red flags on either side. But a lot of times, I guess the key takeaway here is if you're looking to sell your business or you're looking to buy a business, it's very important to look at the full financial picture and not just focusing on the income statement.
All right, moving on to the management structure and governance flags. So a big one that we always like to call out is owner dependency. So a question that a seller should ask themselves is how involved are you in the day-to-day business, or how dependent is the business on the owner's day-to-day involvement? Sellers should really consider finding and building a strong management team prior to a transition, especially if they don't plan to stay with the business. There's some instances where, we see maybe a younger owner that's looking to partner with some sort of buyer, but if an owner is looking to sell because they want to seek retirement, a big piece is building your management team and getting them in place because buyers typically like to see key management stay in place after a transition. Another flag is undisclosed liabilities, which can dramatically alter the business's value just due to the unknown risk of these. High employee turnover. This is a flag that can indicate maybe poor company culture or some other underlying issues that don't stand out in the financials. Late or incomplete financials. So typically the timing of monthly financial close can indicate how a business is running. A fast close typically indicates strong internal processes, whereas a slower close may indicate that there's some holes that lie within the processes. Related party transactions, we've seen a little bit more of this lately, and some big things for sellers to consider that can alter EBITDA or potentially the value of the business are below market rent rates. So this is typically when rent on the P&L is less than actual market rent should be. So they're showing less expense, which will reduce EBITDA if you make an adjustment for that. And then any owner personal expenses will result in an adjustment. And then typically we could see family members on payroll, that could be an adjustment, or shared expenses. If an owner potentially owns 2 or 3 businesses and maybe they operate out of the same facility, or they share services in a way, somehow they allocate these costs across these different entities. So it's important to make sure that the standalone business has the correct amount of costs from these shared expenses. And then another thing we typically see is aggressive add backs. So one thing here is this can just raise flags for buyers and build distrust early on if you come in hot with aggressive add backs on the front end. And we just always like to mention that all adjustments to EBITDA for personal or non-recurring expenses need some sort of justification or some sort of underlying support. And, just as an example, it's not usually reasonable to add back 100% of meals if a portion of these are related to the business. So that's just a piece that people can kind of misstep early on and kind of create that distrust there.
Okay, so now we're going to move into understanding the quality of earnings and why it matters. So I think to pull back a second, oftentimes if it's a first-time buyer, first-time seller, what we run into is maybe you're talking to a potential buyer, they ask for some financial information, you feel like you've given up a lot of information for them to present you with an LOI or letter of intent to buy your business. You sign that letter of intent and you think you're 90% of the way there, about ready to close this transaction. Well, the truth is you're just really getting started. The way I like to explain it is up until signing of an LOI, the buyer is really in that trust phase of they're getting financials from you, they're asking you questions about your business operations, but they're not really verifying any of it. They're just taking it at face value, and that's how they're coming up with their offer for you. So then once you sign that LOI, you've entered into exclusivity between the buyer and the seller, and that's when they're going to really peel back the curtain and say, okay, now I'm going to go through and do a quality of earnings and actually verify that everything that you told me is accurate. So I think sometimes I compare it to buying real estate of, okay, you go look at a house or look at a building, you put in an offer, but once you put in that offer, then you're going to go through and you're going to do that inspection. And if you find something that, there's an issue with the building, well, you're probably going to ask for a reduction in the value or things like that. So I think that's a very applicable way to think of it, just in something that everyone can think through in day-to-day life. Okay, so what is equality of earnings? Equality of earnings is a report an independent financial advisor is going to perform to determine if the free cash flow or EBITDA earnings stream that has been presented during that pre-LOI phase is valid. So again, this is going to be a third party typically. So such as Morgan and I will come in after a buyer has an LOI with the seller, and we'll come in and we'll perform a quality of earnings. And really the point is to test those red flags that maybe have been identified. On the seller side, if you do some of this due diligence up front, then really you're not in this discovery phase when you get into the quality of earnings due diligence phase. It's more just verifying and supporting what you already know. So like it says here, equality of earning, it adjusts the reported EBITDA to a true sustainable run rate figure. So as Morgan mentioned, some of those add backs that would be non-recurring or personal expenses that really a potential buyer isn't going to incur on a go-forward basis. Validates revenue recognition policies. Really, if financials are not prepared in accordance with GAAP, then it's our job to come in and try to figure out, okay, what is the adjustment that's needed to get those in line with GAAP, assess working capital requirements and normalization, setting a working capital target in a deal is always, I think, one of the number one probably misunderstandings that doesn't get negotiated until the very end of a transaction. So we try to get ahead of that. And then again, just provides a basis for the purchase price and deal structure. So it's not only confirming the value, but it's also confirming if the structure is appropriate. So maybe there's, maybe there's findings that come up that it restructures the deal to not all be cash up front, but maybe there's an earn-out piece to it. So let's look over at this EBITDA bridge and kind of talk about how we get from reported EBITDA to that adjusted EBITDA number. The first one being owner add back. So you can see here it's a positive adjustment. The owner was paying themselves an excessive salary. So if we adjust that for normalized salary going forward, that increases EBITDA. Now, non-recurring revenue, maybe you sold vehicles during the year or you received some insurance proceeds and that was initially counted as revenue. Well, you're really not in the business of selling vehicles. You're not in the business of getting insurance proceeds. So those aren't true piece, or that's not a true piece of your core revenue. So we're going to back those out. And then this working capital adjustment, it's really not part of your EBITDA necessarily, but it's a final adjustment to the purchase price. So what happens is when a quality of earnings is performed, a target working capital is set, and it's assumed that at close you'll deliver within that target range working capital as part of close. And if working capital comes in above or below the target that's set at close, then there's an adjustment to the purchase price. So that bridge gets us to adjusted EBITDA. Now, the working capital is really a dollar for dollar adjustment, but when we look at those owner add backs and the non-recurring revenue, okay, the delta of that is what $300,000. Well, when you think of when you value a business, if you're taking EBITDA times a multiple, well, that's 300,000 times whatever multiple that is. So if you knew that up front as a seller, okay, let's say you get a 5x multiple, 300,000 times 5 is $1.5 million. I think as a seller, you'd much rather know about that adjustment before getting to the LOI phase. And same from a buyer perspective. If I find out that, hey, the value really should be 1.5 million less, then I'm probably going to come back and try to renegotiate either the structure or the value of the deal. Okay, so common quality of earnings adjustments. I think Morgan touched on these, but we'll just run through these quickly as examples. So owner compensation in this example, the owner was paying themselves $600,000 salary. The market rate is about $250,000 on a go forward. So that's going to be a positive adjustment to EBITDA. Now, on the flip side, that's not always a positive adjustment because we also often find that maybe owners of a business are underpaying themselves, and really how they're compensating themselves is through distributions, which doesn't hit the income statement. So it can be a negative adjustment as well. It just kind of depends on how the owners are compensating themselves within the business. Non-recurring expenses. If you have one-time legal fees, maybe significant repairs, or you implemented a new software during the year and you're not going to incur those costs every single year going forward, then there's oftentimes a good argument that those can be added back as non-recurring expenses. Non-recurring revenue, PPP forgiveness was a big one a few years back. Insurance proceeds, like we said, the sale of a vehicle, unless you're a car dealership, you're not in the business of selling vehicles. So if you receive proceeds or have a gain on that in your income statement, we're not going to include that in your EBITDA calculation. Morgan mentioned this one. Related party rent is a very common one. Oftentimes we see business owners having separate entities that hold the real estate for a business. And it kind of varies. Sometimes we see that they're paying themselves above market rent. Sometimes we see that they're paying themselves below market rent. So what we have to do is figure out, okay, what is that true rent rate on a go forward, and we'll adjust the financials accordingly. And then personal expenses are a very common one, especially when we have tax-driven business owners that are trying to reduce that taxable income. We see a lot of personal expenses running through financials. It's funny because I think a lot of times business owners don't want to tell us about their personal expenses, but especially as the seller of a business, it's very important to identify these because, like I said, when you take $100,000 times 5, well, that really starts to add back from a multiple perspective, or add up from a multiple perspective. But common ones we see are travel, credit cards being utilized for personal expenses, personal fuel and repairs and maintenance on vehicles. Maybe you're paying your son or daughter on payroll, but they're really not active within the business. So we really go through and try to identify some of those personal expenses that once the business exchanges hands with an owner, that those expenses will not continue. And then revenue, timing, and cutoff issues, again, going back to proper revenue recognition. If you have, customer deposits, or maybe long-term projects, or if you are behind on billing, those are all kind of key items that we often see that maybe there's an issue with rev rec, especially if you're on a cash basis. And then inventory on the flip side, when you're thinking on revenue, you've always got to think of the cost side of things. And I would say businesses with inventory are ones that we most often see issues with, the costing of inventory and whether it's properly booked to the balance sheet and then brought into the income statement at the time of sale. Okay, so as far as, I guess, the positives of quality of earnings for a buyer and a seller, like we said, for a buyer, it's going to validate the price that you've offered to pay for this business. And then also, if there are any red flags, as a buyer, you would much rather identify those and investigate those prior to closing a transaction than post-close when you've already written the seller a check. It strengthens your negotiating position. So if there are issues that are identified, you're not just talking about potentials, but you actually have the hard facts of, hey, we looked into these numbers, we got the support, and this is what the data is showing us. Depending on how you're financing the transaction, whether you have investors, you're going through a bank, a lot of times they're going to require this quality of earnings. And then again, I think I just touched on it, says here reduces post-close surprises. Yes, it costs money to do due diligence, but it costs a lot less money to do due diligence than it does to have something blow up post-transaction and you just spent millions of dollars for a business that maybe you should have spent a couple million less for. Now for the seller, if you do a sell side quality of earnings, one, you're, figuring out all these potential red flags and getting answers to these before a potential buyer will find them. So really when you get to the phase of talking to a potential buyer, you're just helping verify and validate. They're still going to find probably those same red flags, but you're going to have answers for those. So you're not going to run into surprises post LOI because you're already going to know about these. One that I like to bring up for sellers is, if a buyer finds negative things in a quality of earnings that would reduce the value, they will absolutely come back to you and try to retrade the deal or renegotiate. Now, if they find additional personal expenses or things like that that you didn't initially identify, I can promise you they're not going to come back and offer to pay you more. They're just going to call it a win and feel like they're getting an even better deal out of the transaction. So that's also a big reason, is just to make sure that you're getting the highest value that you possibly can. Now on the flip side, sometimes we'll have sellers come to us and say to Morgan and I, when we're engaged to do sell side quality of earnings, well, it's your guys' job to get me the most value out of my business. And yes, it is, but we also have to be independent and reasonable. So if we identify something that we know will come up in buy side due diligence, we're not just going to, put it under the rug. We're going to bring it up to you and say, hey, you're not paying yourself enough. A buyer's going to come and they're going to adjust this, or you currently have your gain on sale of assets included in revenue. A buyer's not going to count that. So also just educate you so you don't get to buyer due diligence and then be disappointed because your numbers were not properly stated.
So getting into this third section here, avoiding costly mistakes that can derail transactions. So we're going to try to cover any preventable mistakes that hopefully you can identify early on that won't get you deeper into a transaction and be a more costly mistake later on. So these are the top mistakes that we identify that typically derail transactions. The first one, and this was kind of the section Aimee just covered, skipping or rushing the QOV. So typically buyers will rely solely on the SIM financials without an independent analysis. And sole reliance on this is a little bit risky because it can result in, a valuation change or an issue post-close. And I think one thing we've seen recently is typically smaller deals, they may think that a QV, especially on the sell side, isn't a good plan because the buyer will do one anyway. But we've seen it be pretty beneficial. And, if you engage like Aimee and I, we are getting deep enough in the financials that we can kind of help throughout the full financial due diligence process. And we have a pretty deep understanding of the financials. So we're able to assist more there on the sell side after we finish the QV and even further throughout the process, which is a big benefit. And then the second is accepting EBITDA add backs and not challenging these. So just as we kind of mentioned earlier, it's always really important on the buy side and also on the sell side just to have that underlying documentation so that either side can support and validate the add backs and make sure that, when you get further down the line, maybe a buyer won't accept an add back now, whereas the seller thought it'd be accepted. It's just kind of good to air those out early on. And the third one, and another big one, is just ignoring working capital mechanics. So this can result in closing delays and disputes. And it's really important to discuss working capital early on and kind of determine what the best methodology is prior to those final weeks before close. And, we've seen that sometimes a classic look at net working capital where you take current assets less current liabilities isn't really the correct methodology depending on your business. So it's important to kind of talk through those both buyer and seller beforehand before you get down the line. And maybe it's something that pushes close and can really create some more deal fatigue for both ends. The fourth one here is overlooking normalized owner comp. We've kind of hit on this a few times, but it's really important to kind of look at what market rate is for owner compensation. And as Aimee mentioned earlier, distributions aren't considered owner compensation as they don't run through the P&L. So there has to be some sort of an adjustment to EBITDA to capture those properly. The fifth one is not stress testing revenue stability. So some key questions that you should ask yourself is what does revenue look like if X customer leaves? So if a top customer or one of the top customer leaves, what happens then? Or, if a competitor starts selling one of your largest, most successful products, what's your movement there? How do you address that later on? And then the last one here is just poor communication between advisors. This is a big one that we've seen. It's really important to have your advisors be aligned to close deals properly. So from your legal side, financial side, tax side, having all these teams on the same page, one creates efficiencies and also can help identify any red flags earlier on and help coordinate with the group to kind of figure out what the path is forward.
Yeah, I think the advisor piece is really important. A lot of times we'll find that buyers or sellers will try to keep advisors out of the deal until they absolutely have to involve them because of the cost. But I think some examples of what we've seen where maybe they took too long to bring them in the loop is, one example is buyer and seller had agreed conceptually to what the working capital target was going to be and how it was going to be structured and what the definition was going to be, didn't relay that to their legal advisors. And then purchase agreement starts getting turned back and forth between the legal advisors and they're redlining something that isn't even what's been agreed to conceptually. So right there, you're incurring additional costs just because the attorneys weren't in the loop of what should be documented in the first place. We've also seen where, Morgan and I have done some buy-side due diligence, validating financials, getting ready to close, attorneys have the purchase agreement, and then all of a sudden the seller went and spoke with their tax advisor, and their tax advisor did, a net proceeds calc post taxes, and the seller realized that, hey, these proceeds aren't what I thought they were going to be post tax. This isn't going to make me whole financially. I don't want to do the deal anymore. So there are, completely understand that it costs money to do due diligence, but keeping your advisors in the dark when thinking that might save you money oftentimes can end up, wasting time and money at the end of the day.
So this slide here kind of covers, putting an actual number on what mistakes actually cost within a deal. So approximately 50% of all M&A transactions fail to create the seller's expected value or what they were maybe thinking they were going to get from a transaction or post-sale. And this is primarily due to improper or untimely due diligence, which can be on the financial end, the legal end, the tax end, all of those sides. And then we just noted that it can be approximately 60 to 90 days is an average delay when financial due diligence issues are discovered really late in the process. So this means after an LOI or after financing's coordinated or, right before close. And, this can result in 2 or 3 months of additional carrying costs, advisor fees, and as I've noted a few times, deal fatigue. And we've kind of seen the deal fatigue be a really big piece, and it's hard for both sellers and buyers to overcome this. And so as delays continue on, it just gets worse and worse down the line. So that's always something to consider. And then we noted approximately $500,000 is the average cost of deal retrading or litigation from undisclosed liabilities. So this is just kind of the cost of doing due diligence right, and it's significantly less than potentially doing it wrong or potentially doing it in a delayed fashion. And on that same conversation that Aimee was talking about working capital, 1 in 3 deals face post-close working capital disputes from poorly defined working capital pegs. We kind of talked about this on the last side, but this can also result in post-close litigation. So typically there's a working capital true-up that happens 90 days after close. And we've worked on a few of these engagements in the past where we haven't even really been involved in the deal at all until the net working capital true-up happens. And this can result in some pretty significant disputes, and it creates additional consulting fees for both the buyer and the seller. And typically there are some unfavorable outcomes, which is never good, but kind of that net working capital peg that gets defined in the purchase agreement is a really big piece of it. It can cause post-close woes. So that's definitely an area we try to make people want to consider more. So
Yeah, and I think the most interesting one on here is that first one. It's not 50% of M&A deals fail to close. It's they close and then 50% of those don't create the value that the buyer expected. And most often it's due to not doing the proper due diligence. So that's just something to keep in mind as Morgan comments on, 500,000 is a lot more costly than the cost to do proper due diligence. Well, same as the 50%, you'd much rather spend a little bit of money to not go through with the transaction that's not going to produce the value that you expect it to, than to go through with it and then potentially lose money on your investment.
So Aimee and I have given a lot of red flags and mistakes and things to avoid. So what should you actually want to do, or what should you actually want to include on your due diligence list? We've included a financial due diligence checklist here. We kind of consider these the must-haves, but this isn't everything. So these are just kind of the key items that we've identified. So we'll start with the financial statement side. 3 to 5 years of quality and consistent financials is a big piece of this. And then having a monthly P&L for the trailing 24 months just gives a buyer a good view. Typically that 2 to 3 to 5 year range is really important for buyers to kind of see a full range of the financials and, across different markets and different years. And then a balance sheet with aging schedules, as we kind of mentioned, looking at that AR aging kind of gives insight into cash conversion cycles. And then another big piece is tax returns matching the financial statements. So that's typically a first check that due diligence teams do, is matching the tax returns to the financial statements. And then having access to the chart of accounts and general ledger access is important. Then moving to the revenue and customer data, having customer level revenue data for the past 3 years, we typically say. This just kind of gives insight into if a customer concentration exists, or if there's, the top 5 customers make up 90% of the business. That's something that's important to know. And then that kind of moves us into contracts on both the customer and vendor side. This is a lot bigger piece if there is a customer or vendor concentration that exists. So those are important to kind of have ready and prepared to provide if needed. And then backlog and pipeline reports. This just kind of gives insight into the future of the business and kind of where the business is tracking. Pricing history and discount policies. It's always important to see how the business responds to, inflation and price increases. So those are important to call out and have documented as well. And then revenue by product and service line. This just gives due diligence teams insight into maybe if there's a product or service line that has very high margins, or if there's one that's predominantly taking over the large majority of revenue. So that's just an area that we review as well. And then moving into the operational and other category, just having an org chart and key employee list that kind of details out who manages who. Compensation detail that includes benefits. This is a key piece, especially on the owner side, what the owner makes, what their benefits are, kind of what they cover. And then lease agreements, specifically real estate and equipment. We'll review those, as we said, if there needs to be some sort of rent adjustment there. And then capital expenditure history and budget. This is a big piece for more capital intensive businesses, because this can typically reduce your cash flow if there's pretty high CapEx needs for the business. So that's something that due diligence teams will review as well. And then any pending litigation and contingencies. These are always big to bring up early on so that your advisors know. I know sometimes it's a piece that maybe people don't think about as much, but anything that comes up litigation or contingency wise is very important. And we just always kind of say that it's really good to start determining and building these internal processes to support all these requests we just went over. Even if a potential transition isn't for a few years, it's important to start doing it now so that you can have the 3 to 5 years of data that's really strong and easily accessible. And just having all of this data readily and easily available can really accelerate a deal quickly. We worked on deals where someone has all this information ready and it can streamline it significantly versus someone who maybe has to pull information in different phases, and that takes a long time and kind of extends out the deal.
Okay, we're gonna pause for a couple of minutes just so everyone has a chance to do the polling question if you need CP. Okay, hopefully that gave everybody enough time to answer the polling question. We'll go ahead and keep moving here. So now that we've talked about the red flags, let's continue to talk about deal accelerators that can build up buyer and seller confidence to ultimately get ahead and have a smooth and successful close in a transaction. So Morgan touched on some of these, but key deal accelerators in our mind are, a sell side quality of earnings or some sort of due diligence, pre-look at your financials to identify any of those potential red flags that we've talked about. An organized data room, that's something that if you use an advisor, like Lutz will host that. But even just even needing a data room, starting to get your information organized into folders on your computer, things like that. Morgan's talked a couple times about deal fatigue throughout this presentation, and when the deal fatigue hits is normally between that LOI phase and closing of the deal. So the more data that you can have organized, in a personal folder and just ready to deploy when needed, the more time you're going to save, when you're getting thrown with all of these due diligence requests and things like that, to have those readily accessible. So can't stress enough that as a potential seller, even if you're not thinking of selling in the next year, 2 years, if you have customer contracts, vendor contracts, any data that potentially could be needed if you will sell your business eventually, start getting organized now, because I promise you it will save you headaches when you do get to that phase. Management reporting, know your business. Good data means good business decisions. So if you're tracking KPIs, have those monthly reporting packages with your financial statements and key information. Start creating a budget or forward-looking projections. And again, it's an accelerator. A lot of times I would say our smaller business owners, they don't have projections and things like that, but it's certainly something that we can help with. I think the key thing here is, as Morgan talked about, consistency in what you're doing. Don't change the way that you're doing things every year or month. It just creates a lot of gray in your financials that make them hard to interpret, that even if maybe your financials aren't on full accrual basis or, not perfect from a revenue recognition, as long as you're consistent, then someone like us can come in and easily calculate what that adjustment needs to be to get them on that. Now, if you change things and do everything differently month to month, then it makes it a lot more timely and costly to try to get those financials properly stated. And then deal team alignment. Again, when you get to that point, when you think you want to sell your business, before going and talking to potential buyers, know who your team is. Who are you going to use for legal? Talk to your financial advisor. What is it that you need for a liquidation event of your business that you can be comfortable in retirement or whatever your future wishes are post-transaction. Talk to your tax advisor. Do you have the right structure in place to make sure that you have, the most advantageous outcome from a tax liability perspective? Okay. So seller preparation, I'm just getting more into the weeds of things to think about. Like we said, engage a CPA or an advisor. This says get a sell side quality of earnings 6 to 12 months before you go to market. Honestly, at any point in time, even if you're already past that 6 to 12 months, it's not too late to talk to somebody about making sure your financials are in order. It's also never too early just to, think through things maybe that could be changed to get you prepared to go to market. That goes hand in hand with cleaning up your financials. Completely understand the reasons that personal expenses get ran through financial statements, but other than tracking personal expenses and having the backup documentation to support that to a potential buyer, the easiest answer is just don't do it. Stop running your personal expenses through your business. Now, it's probably not the reality most of the time. So, maybe have a specific credit card that those expenses get put in, or maybe there's a specific expense account that everything gets coded to. So those can be easily identified when they need to be supported down the road. That leads into documenting add backs. We want to make sure that we can take credit for any of your personal expenses or non-recurring expenses, but make sure that we have documentation. Sometimes we see what I like to call people get add back happy, where they just start throwing the kitchen sink out there of, well, this could be personal and this could be personal, and be reasonable. Okay, what's truly a personal expense? What maybe is more business related? Get appropriate documentation so it can be justified and we don't have to worry about a potential buyer disallowing those add backs when they get into their buy side due diligence. Build a data room. We already talked about the more organized you can be up front, the much smoother and quicker the process, and then go to market prepared, which I think just sums up all of those bullet points together. Okay, so building buyer confidence. What are some of the things that, increases buyer confidence leading into due diligence? Audited or reviewed financials. They're not necessary, but they do set the base that, hey, a CPA has looked at these financials, so you likely have, at least on an annual basis, strong GAAP financials. I will say, if we flip over to the sell side QV report, oftentimes we'll get questions of, well, if I have audited and reviewed financials, do I still need a quality of earnings report? And our answer is yes, because an audit and review, one, it's looking at it on an annual basis, and a buyer is going to want to look at a trailing 12 months. So if you're December year end, but right now we're in the month of April, where they're gonna want to look at your financials at a trailing 12 months ending March, not December. So if there's maybe significant adjustments that get made at year end or on a quarter basis, we need to make sure that you have good financials on a monthly basis so we can calculate a trailing 12 months and not just look at it on an annual basis. Also, audits and reviews, they're not looking at EBITDA and pulling out your personal expenses or non-recurring. They're still going to capture all of those in that. And then lastly, there is materiality that comes with audits or reviews. So maybe there's a $25,000 adjustment that can be passed on in an audit, but when it comes to selling your business and taking $25,000 times a multiple, that all of a sudden becomes a material number that we want to make sure that we can quantify and account for. Recurring and consistent revenue streams, again, just proving that you have sustainable earnings going forward. If revenues are lumpy and going up and down, that can cause buyer concern. Customer diversification, trying to avoid those customer concentrations. If you do have customer concentrations, trying to make sure that there's contracts in place that can build buyer confidence that that customer, can't walk away if the owner leaves or sells the business. And then some of the medium ones, clean and organized data room, strong management team, historical revenue growth trend, we touched on that. And then the more documented processes and procedures that you have in place, the stronger confidence the buyer's going to have. Okay, so this slide just kind of touches on some of the differences in what timelines can look like when selling a business versus a prepared seller and an unprepared seller. Now, this first line where we talk about market prep and data room, this is talking as though a business is going to go through a full auction process. So you're going to build market materials, you're going to go out to multiple buyers, you're not just talking to one buyer. So just keep that in mind of some of the timing things. But typically, if we're assisting in building marketing materials and building a buyer's list, that can take about a month to a month and a half. If we've got good information, the seller can give us all of our requests. Now, on the flip side, this up here says 3 months for an unprepared seller. But truthfully, if we find that financials are, completely misstated and not representing what maybe the seller thought they had, well, it could delay a transaction by a year or more because all of a sudden a business owner thought they had $2 million in EBITDA. And then once we get a chance to look at the financials and appropriately state them and they've got $1 million in EBITDA, well, all of a sudden they might not want to go to market anymore. So that's really important. The IOI and LOI process, that's typically about a month. That's really the pre-LOI phase when requests are being made for financial statements, potential buyers learning about your business, but you're not disclosing any, information such as customer names. You're not giving out names of your key employees. You're giving them enough in that trust phase to present you with an IOI or LOI, kind of depending on what the approach is. And then buy-side due diligence. Well, the buy-side due diligence, negotiation of documents, and then closing, all of that happens post-LOI and somewhat happens at the same time. Typically, a buyer is going to kick off with the quality of earnings or financial due diligence because if something's going to kill a deal, it's probably going to come up in the quality of earnings. So they'll start with that. And then once they have confidence that, okay, the numbers are at least coming in where we thought they were, we don't need to renegotiate the value of the deal, then they'll get the attorneys involved with the purchase agreements and things like that. But I would say when signing an LOI, typically we see exclusivity being between 60 days to 120, probably being the longest. And that's really the time frame that says, okay, once this LOI is signed, that's how much time we have to get our due diligence done and close this deal until we run out of exclusivity. Now, oftentimes, if you're at the finish line and there's just some final boxes that need to get checked, that exclusivity gets extended. But part of the reason of that exclusivity piece is to make sure that the buyer is also serious and doesn't just, come in, kick the tires, want to get some of your information with no intention of actually closing the deal. But all that to be said, you look at the bottom, estimated timing, unprepared seller can be anywhere, it says 10 to 12 months, but really it could be 10 months or a year or two. Whereas a prepared seller, you can save yourself a lot of time. We've got 5 to 6.5 months if you're going through the, a full sell side process, which obviously time is money. So at the end of the day, if you're having to engage advisors, things like that for an extended period of time, obviously that's going to become more costly on both sides for the buyer and the seller. Okay, so key takeaways from this presentation. like we said, red flags, they're not deal killers, but they do require some sort of investigation. So the more, as a seller, you can be on top of these and have answers for them up front, the smoother the transaction's going to go. Due diligence is, we say the single most important step. Maybe we're biased, but I do believe that it is the most important step in an M&A transaction. And that's really not just the financial due diligence, but legal due diligence, compliance, anything that comes with it, really verifying that this is, an appropriate transaction to go through with. The most costly mistakes happen early. This says before signing LOI, but I would say it's probably the most costly mistakes happen without identifying them pre-LOI and then getting into an LOI and then, getting behind the curtain and determining that something isn't quite what you thought it was pre-LOI. Prepared sellers win, whether it's a sell-side QV, getting your advisors involved, it's always going to result in a more smooth and timely transaction. And then trust is built through transparency. So as a seller, if you can come with answers to questions, be well organized, that's always going to build confidence in your buyer and create a successful outcome for both parties. Okay, so I know we have just a few more minutes. We will send out the materials and you guys will also be receiving a survey to fill out. Within the materials, if you guys have any questions specific to, your individual or business needs, please feel free to reach out to Morgan or myself. Our contact information will be on that presenter slide in the materials that get sent out. Otherwise, if there's any questions right now, like I said, we do have a few minutes. And if not, we really appreciate everyone's time. Right, I think there are no questions at this time, so we'll go ahead and let everybody go. But yeah, if any questions come up once you have a chance to digest or review the materials again, please do not hesitate to reach out. We're always happy to have a conversation off the clock just to understand your guys' potential needs. Have a great day.
Thanks, everyone.